All right, good morning, everybody. I wanted to start with this daily picture of the S&P. So it's kind of a zoomed in 1 year chart, daily candles. And this is a picture, I believe it's from Grimes, but it could be one of the other analyst textbooks that I've read. I kind of lose track of it after a while, but I'm going to give credit to Grimes, even if it's not his. Poor guy. This is what we've got, right? That's a topping pattern, pure price method. It's a reversal. We've been enjoying the short, but now we've got this rally and we're right here. On this picture, it would be spot number one. So it's after we've made this second break, we profit from the run to the downside. We've shot all the way up and we're now testing spot one. So if this downtrend is going to hold, it has to hold here. Now we can overshoot. There's nothing that says, we got to stop right on the line. And remember, liquidity resides on the other side of the pivot. I'm going to just keep telling you that until you start to believe me. So at the very least, we are going to expect to overshoot that a little bit and get up here. The main thing is, if we're going to stay bearish, that we don't stay up there. So we could possibly see a candle close above, but on the week, we don't want to end the week above 4,400. If we do, then this topping pattern is void. We're done with it. Now, that doesn't mean we're going to go up. We can void this topping pattern and we can still just chop about, languish for a while, and then still drop right back down again. But it would negate and void out this pattern. So it's something that we want to be considering. And this sort of insight on price action, there's nothing unique about it, right? That's a book that is 30 years old, at least, if not 40 years old. It's been around for a while. It was a photocopied PDF when I read it. So, I mean, yeah, it's old. But this stuff doesn't change, right? And it can be used on any time frame. So once you learn this, it doesn't matter what kind of trader you are. It doesn't matter exactly what you're trading either. FX, futures, stock, options on futures, whatever. Price is price, and it'll work on any time frame you want. Day trade, swing trade. All right, Hong Kong's still down 0.5%. Japan is up nearly 0.5%. Europe's sitting around a quarter, and then our markets are basically flat. Our markets are waiting on Powell. We're going to have Powell speaking today. I tried to find something with some depth to it on what he's supposed to be talking about, and I didn't find anything that I liked. To be fair, I didn't look for very long either. I took it from two perspectives. If it was something really big, I wouldn't have to look very long. And so, I kind of gave up really, really quick because I had other things to do. But the fact is that we are sitting on pause, waiting on Powell. Now, these are going to be opening remarks. So, not expecting too much out of that alone. Remember, the biggest threat is always during Q&A. Wholesale inventories is also a little bit of a threat. It's not showing up here as much of a threat on FX Street, but I would watch the clock at 10. Crude oil inventories, crude's really been having some nice moves to the downside, but if we're going to see a sea change along that structural support, today would be a good day to start to see that change. So inventories at 10:30, you can focus on USO, and sometimes steel gets a little bit of love during all of that. We do have the 10-year at 1 o'clock. This is a pretty big deal. I know it doesn't show it here, but the 10-year is important. They're all important, right? It's like trying to say that you love all your puppies the same. Yeah, maybe you do, but you probably got a favorite, you know. That 10-year is important. We're going to get a lot of data out of Japan tonight. So before we go into the close, take a really good look at what you own and ask yourself if you're comfortable with a 5% move in the S&P to the upside or the downside before you come in tomorrow. I don't know that we're going to get that move, but as we're going to go see here in a minute with US dollar Japan, you might get that kind of move. And that's the threat that's on the table. Could see a little calming in the loonie too. One step at a time. All right, here's the daily chart, US dollar Japan, and we are on the run back towards the upside. Just measure that really big bar. There's the 50%. We are well above it. We're broke outside of yesterday's range. If we wanted to just do the impulse, then we would measure this. Again, we're above the 50%, and we still have that breakout. So no matter which way you cut it, that's bullish. This is a really structured, really tight TRB setup as well, and it's a liquidity gap. So the move down here was an attempt to close the gap as far as I'm concerned, and they've given up on it, and now it's continuing the move that originally happened to here. Right now, the 10-year for Japan is down. And this is the only thing that's kind of keeping me calm on this entire situation, is that this isn't also ripping to the upside. So with US dollar Japan sitting at these levels above 150 and 150 and a half, and now pushing towards 151, I'm still not seeing the threat of intervention as badly, because this isn't also getting up into that 0.96, 0.98. So with this fading back, feeling a little better about it, but not by much, right? So watching US dollar Japan by itself, it's already at the level of that we would consider a threat. So, if you're waiting for the light to turn on to tell you something, well, the light is on. So now we need some other signals. Sitting and continuing to stare at US dollar Japan isn't really going to help us. We've already got the signal that there's a threat. I think watching the Japan government bond 10-year yield is going to help you see if that threat is coming at you yet or not. All right, so Crude fell out of bed. We're making those moves to the downside. At this point, we are through the halfback. So we got our halfback break. We got our target of 71.45, which would be a 25% mark past this 50%. It's where we would be looking to stabilize. This is some pretty fast moves, right? So we're going to get inventories today at 10:30, and it might exacerbate this move, get us down to 72 a little bit faster. Bitcoin still holding that high in a very, very sexy textbook bull flag. I mean, that's one for the books right there. And of course, with US dollar Japan continuing to rise, we've got gold and gold miners and silver down. All right, volume's light again this morning. It's not too light, but it does show how the markets are waiting on Powell, and they're not overly concerned, at least not yet. We don't have a market maker move. They're not hedging in the front end. They're just sitting out. It's not a really big deal, and it kind of fits into the narrative that we've continued to lean on all week, and that is that the market made some magnificent advances last week, and it's got a lot of digesting to do if it's going to keep what it ate without puking it up. How's that for some morning talk, huh? Can't be any worse than dead cats bouncing. We don't have an MDP, and we're still very extended past the weekly pivot point. So as much as we don't like to use the phrase overbought or oversold, we're about as far from that weekly pivot point as we would expect a market to get. Right? Anything beyond that really starts pushing into some obscure probabilities that we don't see very much. So it's not to say that we can't go farther, just that we're about as far as you'd want it to go. Looking at things on the weekly chart, we are still right where we were last week. We've got our inside week breakout, but I mean, we really haven't gone anywhere. Still holding at that 4,400 level. There's those two wicks to the left, really important. Below 4430, we've still got the threat that this isn't going to make it through that zone. So one thing at a time, we've got to get into that zone. 4432 is a cog line. And then we've got to get past it and close above it on a weekly. And so far, we haven't even managed to get into it. Long ways to go before we would start to consider any sort of real rally into the end of the year. At the very least, we can say that we've got our inside week breakout, and that's holding really well. But I mean, that it doesn't give us very much. Because of the moves that we've had lately, the ADR levels are really far away. Our average daily range right now is 1.3%. So from where we open in the Globex, we can split the difference. And that's how wide apart these two red lines are, 1.3%. Because we could go half and half, and that would be our move for the day. But we could also just go one direction, 1.3% to the upside, and or one direction, 1.3% to the downside. Right now, we just want to focus on where's those two red lines. That's the ADR half, 43.68 and 44.26. The reason that those red lines are so important is it's the 21-day average. So just to remove all of the fancy talk and complex technical analysis stuff, think about your own daily life, something that you do every single day. I get up and make a cup of coffee. No joke, no kidding. Every day, get up and make a cup of coffee. That's my it's my average. It's what I do every day. So you kind of assume that what you do today is and tomorrow, and it's your average thing, that you're probably going to do that again tomorrow because it's what you do on average every day. Well, those red lines is marking what the S&P does every day. What it has been doing over the past 21 days, it's a market month. So we expect today to do what we did every other day, to go to the red lines. Now, we don't have to go to the red lines. When it's one of those really stagnant days where we just aren't doing anything, we can avoid the red lines and stay chopping sideways and never get near them. Otherwise, we're going to expect the market to do what it has been doing consistently over and over and over and over again. There's those red lines. So there are days where we don't go. Friday and Monday or Monday and Tuesday for an example, kind of holding with that theory that we're just not expecting much of a move after such a massive move last week. We're kind of still digesting the levels and we're not going to those red lines. Once we start going toward those red lines again, we'll know that we're ready to start making moves again. And we got kind of close yesterday. So when you put it in that context, it starts to make more sense why we focus on those red lines, because they are the average. It's what we do. Go to the lines. 10-day, 30-minute volume profile. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. We don't really have a classic shape right now. We still don't have the point of control from the TPO up here. So we look at the blue one on the right-hand side. It looks like a volume profile, but it's not a volume profile. It's TPO, time, price, opportunity. It's volume by time rather than volume by price. And what we can see is we haven't spent as much time at these highs as we have at these lows. And yet we've got more volume at these highs than we did at these lows. And that's what that's telling us right now. That's the discrepancy. So there is a massive amount of volume coming through here. As much as this is supposed to be a sideways week with a real lack of movement, it's not a lack of trading because we've got the volume. Sounds like Arby's commercial. We got the meat for sandwiches. Come on, man. It's early in the morning. You got to smile about something. The Monday VPOC was wiped out during that push yesterday. There isn't any reason to have one for yesterday because we've already cut through that zone multiple times. If you're just using basic textbook volume profile analysis, you would want to carry forward yesterday's point of control and the value area high and the value area low. But we're using VPOC, and so we're only going to carry it forward if it hasn't been hit yet. like these down here. You can see where we had a day print out volume profile. If we mark that point of control, we've never come back down to hit it. That makes it a BPOC, and we'll keep it there until it gets hit. We've still got a few left to the upside, including 4,500. And as you can imagine, it's been there for a long time. All the way back here in September. Been there for a while. $10-day, 30-minute volume profile. That thing has value to it as a snapshot. So I didn't mention it when we were there, but if you're new to using that profile, take a picture just once a day, every day at the same time. And after about a month, stack them all up side by side and look at them. You'll start to understand that it's a snapshot in time. We're 1.6% above the 10-day. We've completed our swing high and we're on our way back down. The idea isn't that we have to get all the way back to the 10-day to complete the wave, just that we are on the way down. Peaks and troughs, right? From one side of this, the 10-day is going to continue to move towards us. As long as we aren't outrunning it, it'll get to us. And on the other hand, if we do continue to sit sideways, it gives it a chance to catch up. If we drop down towards it, we'll get there faster. We're 1% above the 10-week, just barely getting started on a new wave here to the upside. And we had, that one back in September that just really kind of fizzled out and didn't get us anywhere either. So it's like a retest, try again, do and redo. So we're still on the drive. We've not yet rolled and curved to start coming back yet. And we're just getting started. So as far as this is concerned, we're not even close to being overbought. Having said that, this white line is linear regression. We tend to get what we give, right? It's a bit like a reciprocating saw. If you get 1% on one side, you tend to get 1% on the other. You get 2% on one side, you get 2% on the other. That works for things like RSI and stochastics as well. So something to think about. If you get a RSI print of 92, it owes you a print on the other side of 8. Keep that in mind. It really has insight when you start looking at oscillators that way. But this has given us a substantial move to the downside that we now want to plot in the other direction because, as I just mentioned, you get what you give. That puts us at 4,500. It certainly gets us past this 4450 or 4432 cog line pivot point that I highlighted on the SPX earlier. Now, we've seen plenty of times where this will get blocked and it won't give us what we are expecting. Here, for an example, on this low, it had already made a significant move to the downside, and so we really didn't get much on the downswing here. And it was really just because we were registering a new turn, right? A new leg. But if we run it back to the first of the year, all right, we'll do a 3-year. Helps if you get the right line. You can see the same thing applies always, right? You get what you give. Same thing here. So we got plenty of room left for a move. That thing go away. Whatever. It doesn't want to go away. Over the past 5 days, cloud computing has moved 8%. Financials through KRE has moved almost 7%. Semiconductors almost 6%. Airlines 5.8. Solar 5.75. China ADRs 5.5. The FANGs a little more than 5.25. So as much as we've been talking about the FANGs doing all the work, we can see plenty of stuff here that's been doing a lot more. Now, sure, we've got cloud computing names in the FANG. We've got semiconductors in the FANGs. So, you know, yeah, it all kind of ties together. Nat gas is down this morning close to 3%. Bitcoin's down more than 1.25%. And then gold somewhere between 0.75% and 1%. Emerging markets or the China ADRs, 0.75% if we're looking at emerging markets. But the KWEB constituents aren't even down 0.5% yet. And then we've got a lot of things that are just flat on the morning. But things that are up, bonds are up 0.5%. And that's good to see, right? I mean, risk parity is dead. So the idea that bonds are up doesn't necessarily mean we expect stock down. And in fact, what we've been seeing is bonds up, stocks up. So not necessarily a bad thing. But nothing else is really up enough to hit our benchmark, at least not from this list. But I don't have, pot stocks in that list. So nat gas, crude, Bitcoin, precious metals in that order, and then China ADRs. That's everything that's down today. On what's up, pot stocks, bonds, that's it. None of these others are up enough to meet our criteria. We can't have a rally in the market on pot stocks. Nah. No. We are starting to see more and more dash for trash, penny stock, junk getting option flows. Just little no-name, forgotten, beaten down junk. So you want to keep your eye on, as a proxy, it's really worth keeping your eye on ARC. It's not perfect, but I mean, it kind of gets you in the right direction. It's a nice tell, just like looking at KWEB for the China ADRs is a nice tell. You can use ARC to kind of keep track of that penny stock trash. Of course, keeping your eye on the Russell, the NYSE, It's a good way to go too, but there's so many names in that space, right? The heavy options flow from whale stream is what I was referring to a little bit ago when we were talking about UOA, some of the names that I've seen coming through there in the last few days. So we've been seeing a lot of divergence. If you look at cumulative tick yesterday, we were below zero. And we had green line leadership to the downside starting at 11 o'clock. I mean, that is steep and it is significant. And yet, take a look at the S&P and how we rallied up and we closed near the high of the day yesterday. So that's a massive discrepancy between that and the S&P. Take a look at the weighted, not the weighted, the advancing minus declining issues, the formula advance minus decline in the NASDAQ. And it closed in the positive at around 30. It closed with 65 out of 100 names advancing. Now, the S&P, on the other hand, advance minus decline in the S&P 500, closed below zero at 81, with 210 names advancing out of 500. So not even half of the S&P 500 advancing. Two different worlds yesterday, two different markets. The financials closed underneath VWAP, down on the day, inside day breakout to the downside. It held its ground, but it didn't close near the high of the day, weak under VWAP. The NY Fang, on the other hand, did all the heavy lifting. Looks a lot like the S&P looks, or the NASDAQ. Big expansive move yesterday, held those highs, closed in the upper body. So just a whole lot of divergence going on. And yesterday we had the dollar rising and the S&P and the NASDAQ rising at the same time. When you have that kind of situation, don't try to second guess which one is lying to you. Just realize that, hey, one of these is wrong. One of these is not true. And until you know which one is true, the safest thing to do is just stand aside, get out of the road. So we went into the day yesterday with the Dixie sitting up near the high of the Globex session, and it held that high until the later part of the day when it really started to fall out of bed. But by then it didn't really matter. And now we've advanced even more since then. So one of the things about using these other tools and looking at bonds and the Dixie and the 10-year and all of that is when it works, it's great. But when it doesn't work or something is wrong, that you just recognize, hey, this isn't working. Don't try to swag it and figure out what you're going to do about it. Just realize, hey, it ain't working. And it's okay, right? Some things don't always work. This threat with the US dollar Japan is really the focus. Just keep your eye on that 10-year Japan 10-year, because as long as it's flat or going down, then we should be okay for the intervention. Yeah, ARC has really expanded, and that's kind of my point. That move in ARC is exactly my point. It's a great tell, but it's just one piece of the puzzle, right? We wouldn't use just that by itself. And certainly we don't want to trade it, just like KWEB or any EEM, emerging markets. We don't want to trade it. We just want to use it as a tool or an indicator. I'm sure we've all heard at some point that price is the best indicator you could ever use, right? Price action, it's the best indicator. I 100% believe that. So price on ARC, price on KWeb, price on the VIX. Those are indicators to me, and they're valuable indicators. Price on the Dixie, the 10-year, US dollar Japan. So the 10-year is down this morning. We're closer to yesterday's low than yesterday's high. We really want to see this thing kind of stay stagnant, stale, not really moving around. Sure, I'd like it to go lower, but at this point, we don't need it to really fall down today. We just need it to not rise. So let's stay inside of yesterday's range. If we get a breakout to the upside, that's going to be a real concern. We're going to want to keep our eye on the dollar at that point and see if we're getting a breakout in the Dixie, the DXY. Notice that we do have the Dixie closer to yesterday's high than yesterday's low, while we have the 10-year closer to yesterday's low than yesterday's high. So they're not working in sync. And if they do, that's going to be a bigger problem for the S&P and the NASDAQ than anything else, because the ES right now is closer to its high than to its low. The NASDAQ as well, closer to its high than to its low. This is the same discrepancy we had yesterday. The dollar closer to its high, the ES closer to its high, the 10-year closer to its low. Something is off here. Something is wrong. Now, I don't have to, figure it out. I just have to recognize it so that I don't try to use these tools and let them lead me astray, right? And that's kind of the point. And we are going to start to see this disconnect widen. Just it's going to be, one day at a time. All eyes on Powell. Everybody be careful, be safe.